To understand the man who became the world's most successful investor, you have to look at Omaha in 1929, just as the Great Depression began to dismantle the American economy. You see it in the faces of men standing in bread lines, stripped of their livelihoods. Buffett's own father was one of those men, losing his job at a local bank during the height of the crisis. Watching his family struggle for basic necessities instilled a permanent, visceral fear of financial ruin before he even reached his 10th birthday. His home life offered no safety. His mother suffered from a mental condition that manifested as frequent, unpredictable verbal abuse directed at her children. With no protector at home, he became an introvert, terrified of social interaction. He retreated into his father's study, spending hours surrounded by rows of books. In this quiet library, he found a predictable world governed by numbers and logic, a sharp contrast to the volatility of his own household. Seeking to regain some control over his environment, he started his first business at age 6. He would buy 6 packs of Coca-Cola from his grandfather's grocery store and sell the individual bottles door to door for a 5-cent profit. The coins he collected from these sales provided a rare sense of stability. In a house defined by outbursts and an economy defined by collapse, his growing savings were the only thing that behaved according to a set of rules he could actually master. By his teens, he was scaling his operations, pooling $25 with a friend to buy a used pinball machine. They placed it in a local barbershop, creating a passive stream of income they split with the owner. He made his first leap into the stock market at age 11, using his accumulated savings to buy 3 shares of Citi's Service at $38.50 each. This chart shows the beginning of his real education. Immediately after he bought in, the share price dropped to $27. Panic set in. He waited for the price to recover, and the second the line touched $40, he sold his shares to secure a tiny profit. But look at what happened next. Within months, the stock took off, eventually hitting $200 a share. By selling early out of fear, he had walked away from a small fortune. He realized that even the best business ideas are worthless without emotional discipline. To succeed, he would need to learn how to ignore the crowd and focus entirely on the long-term value of the assets he owned. That search for a better system led him to Columbia University after a rejection from Harvard. There, he met Benjamin Graham, an investor who provided him with a rigorous mathematical framework for evaluating businesses. Graham pioneered the cigar butt strategy. The goal was to find neglected, struggling companies whose stock was trading for less than the cash and assets they still held. It was like finding a soggy cigar butt on the sidewalk. It's unappealing, but you can still get one last free puff of value out of it. Buffett applied this by putting 75% of his net worth into Rockwood, a failing chocolate company. He had calculated that their stockpile of cocoa beans alone was worth more than the entire price of the company's stock. When the market eventually recognized the value of those beans, the stock price rose, and Buffett's calculated risk paid off with massive returns. This logic allowed him to make millions, but it left him scavenging in corporate graveyards. He was spending his career trying to extract the final drops of life out of businesses that were already dying. In 1962, this scavenger mindset led him to Berkshire Hathaway, a textile mill that was losing money every month. On paper, it was a classic bargain, trading at a deep discount relative to its physical machinery and inventory. The conflict began when the CEO, C. Barry Stanton, tried to buy back Buffett shares for $11.38, reneging on a verbal promise to pay $11.50. Insulted by those 12 cents, Buffett bought a controlling stake in the company purely to fire Stanton. It was an act of spite that backfired. He now owned a massive, failing textile business that required constant, expensive maintenance. His partner, Charlie Munger, finally convinced him to move past the cigar butt approach. Munger argued it was better to pay a fair price for a dominant growing company than to pay a bargain price for a dying one. Munger suggested a significant shift in their criteria. Stop looking at balance sheets for hidden scraps of cash and start looking for the highest quality businesses they could find. Buffett later estimated that clinging to that failing textile mill cost him over $200 billion in lost opportunity. He resolved to never let his emotions dictate his investments ever again, focusing exclusively on unshakable, high-quality companies. He pivoted to buying monopoly-like brands that dominated their markets, staking $1 billion on Coca-Cola and taking massive positions in American Express and the Washington Post. By turning Berkshire Hathaway into a vehicle to hold these elite brands, he created an engine of wealth that achieved a net worth of $62 billion by 2008. Modern investors can use this same logic without picking individual stocks. You can buy a diversified basket of the strongest companies through index funds. This chart demonstrates the approach. A single company's stock swings wildly, but a top 50 index fund smooths those risks. By holding a diversified basket for 15 years, you bet on the entire economy's growth rather than a single brand's luck. The stock market functions as a filter. It systematically transfers wealth from the impatient to those willing to wait for the long-term compounding of quality assets. If the money was meant to protect him from the chaos he experienced as a child, what happens when he has more of it than he could ever spend? In 2006, he announced he would give 99% of his fortune back to society through charitable foundations. He is effectively dismantling the wall of wealth he spent a lifetime building. He still lives in the same house he bought in 1958 and drives himself to work every morning. The billions were never about the lifestyle they could afford. For the boy who once hid in his father's study to escape a chaotic home, these decades of investing were the ultimate validation of logic. He proved that by sticking to a rational system, one could not only survive a world of volatility, but master it entirely.